gold's doing at the moment.
Yeah, I'm looking at it now. We've got a monthly chart here, and it's right bang up to date. What I've done is put rings around the top parts where I think it's going to look toppy. It did in 2007, did in 2006, and it does about now. You wouldn't necessarily be buying gold now. You wait for it to cool off. Trend is very well in place on the upside, and it's a case of buying on the dips here. And then you use shorter-term techniques to get in when you perceive it being oversold. And I think the trend is going to continue while the dollar remains in this state. And when, as with quantitative easing, when the quantitative easing is still fresh on the horizon and still likely to continue, then gold will go up as the amount of money just in the system
just expands.
Basically debases currencies and makes gold a no-brainer, really.
Yeah, yeah. And I suppose once governments start with quantitative easing, it's difficult to stop, isn't it?
Well, if it does stop, and this is if a change of elections or whatever that might bring, if it does that, then the danger is that we might have a double dip, because most of the growth is coming from government spend. This is the danger. We need it a bit longer. And this is what happened in 1937 and 1997 when quantitative easing dropped off. Then we had the markets went into a difficult phase.
All right, Bill.
A bear market in 37 and prolonged deflationist state in 1997.
So gold long-term positive, but you just hold back for the moment.
I'd hold back. We're looking to buy on short-term weakness. Yeah.
Okay. Yeah. Now, what would you like to look at next?
Well, I've got gold mining share, which is this quandary of do you buy into a breakout situation on a mining stock coming through, like Chariot Gold. This is ticker CGH, and it's looking very interesting. Why is it looking interesting on this chart? Well, it's a monthly chart again, and I think it's very important to have a monthly view. Different time frames are very, very important on analysing shares, because we get very excited by the short term. I think a lot of us can do, and actually getting the longer term perspective in is very, very important. Just to chart where it's been, what's happened, and what's it looking like. This one in particular is moving to Chariot is moving towards a possible upper trend mode, sort of into the on using the comparative strength model, which I think is very, very important for picking shares now. I think it's a stock pickers market, and this is one of the best indicators I think is around to support share purchases. And it's coming through looking quite interesting, nearly a buy. But do you preempt this or not? And this is one of the problems we have, is sort of, do I get in and hoping there's going to be a 3 or 4 bagger that it might start discovering large amounts of gold, and things might be in the pipeline or not. So in a sort of, we don't know necessarily, and this is part of the quandary. And this one's a wait and see, really, because it hasn't crossed the upper threshold, although it's exhibiting extended overbought situation, which is very bullish for me, and with high volume, that's good. It's not strong enough against the market yet to warrant going in. So it's on the back burner, waiting to go in this one.
Okay, Bill, thank you very much for that. So we've looked at gold and a gold miner. Let's have a look now at Lloyds.
Lloyds. Now this is one. Yeah, this is a one to avoid completely. And this is why. The same system again, monthly chart. Why do we avoid it? Because the comparative strength is never any stronger than 55, and it is only that in 2002 for about 3 months. That might have, where the box is on the left-hand side, and where that sort of rectangle on the chart is.
Yep.
You might have been excused for going in at about £5, but you'd have probably got out at £5 as well. So. Not much damage lost there unless you hold on hoping for a dividend, in which case it all goes wrong because there isn't any strength as the share at all against the market, and it's one of those that we've seen an awful lot of money going into the share and they're still going into it, and one wonders why. And using this sort of predictive sort of, or using a strategy here, there's nothing predictive here, is a case of is it strong enough to go in there? It might well be. Now, avoidance, but there is actually, you could say, well, in 2006 is there a glimmer of hope, and when it does actually break that sort of 55 zone, yes, it does again, but it doesn't hold. And if you are in at about £3.50, because of the new high line, which sort of tracks the share price lower, and the darker of the 2 lines there, it would have kept you. It would have kept you out at would have got you out at about £3.50. So you wouldn't have stayed in for too long on that share. So this one really sort of tells you that the whole picture, really. Stay away from it, it's saying.
Okay, Bill.
Yep.
Well, you couldn't be clearer on that one.
Yep.
Now let's look at Fresnillo.
Well, Fresnillo says, "Please look at me."
Right.
Without that, because it's broached that threshold of 355. Starts off on the 6th of March at 385, and it does this again on the 24th of April, going across from left to right at 468. Again on the 17th of July at 535, and again on the 4th of September at 654. Now rolling around at 845. So it's the opposite of Lloyds, if you like. It's to say, well, what shall I buy? What shall I look for? And this is the exact example to look for, or an example of, where we're broaching into those high echelons of strength against the market. And this is really, really important if you want to try and make money.
Okay, Bill, thank you very much for that. And I know you've been a fan of Fresnillo for a while, haven't you?
Well, I have done. It's I've been waiting for it. The thing is this one, I'm trying to wait for it to cool off and wait for it to buy on the dips. And this is the other technique I use is to supplement this, is to say you either when you've got a situation which is performing very well, how do you buy into? Do you buy into the breakouts, or do you buy into the dips after you've established that it's strong? And that's the thing. And the example I want to show you next, the last one, is the Medusa mining.
Right.
Another gold miner. This one, a Philippine gold miner. And this technique here is using buying on the dips.
Okay, so just talk us through that, because you've got the chart versus gold as well at the top.
I have, yes. There's a lot going on here, actually. First of all, let's forget the shorts at the on the left-hand side, but they're looking at the buy points here are actually fashioned and mechanical, sort of by the computer. When it gets to a certain level, it oversold level, it will trigger a buy. And this is the relative strength system by Larry Connors. It's not very. He calls it the Holy Grail, and I think I've seen more successful trading buying into the dips than the breakouts. And this particular system is very productive once you've got a quality share, and that means a share which is trending in an upward trend, and also exhibiting strength against the markets. And now, also on this chart here, we have, well, shall I buy gold? Or shall I buy a mining share? Now, it's only recently now that the share price has started trending a bit lower against gold. Gold has been stronger than the just marginally recently. That gold has been stronger than the underlying share, although it's still on a yearly basis outperformed gold by about 50-odd%. So on balance, I would still be a buyer on the dips on this one. And the answer to the question I asked myself earlier: do I buy a minnow coming through, which might be quite exciting, or do I buy an established gold miner which on the dips? I'd follow the latter route and buy something into strength, buy something which is showing longer-term strength on weakness, rather than buy a breakout hoping that it's going to perform.
Bill, that's very interesting.